Got everything switched on.
Cool. All right then.
So you can get that.
There really is almost no news at all today. And so, cool. All right then.
So you can get that.
There really is almost no news at all today. And so basically, I will be with you quite soon, maybe like sort of like 11:05.
Yeah, no worries.
Cool. So if you don't mind just muting yourself until then, that'd be perfect.
Yeah.
Thank you. Okay, good morning, everybody. 11 o'clock, so we'll get going. There's very little news to talk about this week, and we're women's holiday season, but we are going to be talking to Matt Cable, who's the manager of Rights and Issues Trust. So, as I say, there's very little going on. There's just sort of interim reports and things. I did put out Finsbury Growth and Income because of what's happened this morning. It's a decent size, £1.5 billion. It's trading on quite a big discount. And you can see that discount's been steadily widening. That's a 5-year chart. And it doesn't seem to be sort of steady. The trend seems to be downward still. It yields 2.3, which, as I've said many times, I think is a bit too low for an income fund. But nevertheless, that it is going to be an income fund, and it's all about growing the dividend from here. So this is how it stacks up against the UK equity income sector. So discount-wise, towards the bottom of that peer group, but not excessive. And what's the reason for that? We'll come to. Dividend yield is by far the lowest. There was Troy was the other one that was sort of down there, but that merged with the Global Equity Income Fund, STS. Charges wise, reasonable, but market cap, it is the second biggest one in the sector, and I think that's why it's important to have a look at it. And returns wise, pretty dreadful, bottom really, unless you go to 10 years when it's suddenly second. And that reflects a big drop off in its performance over the last 5 years. And that's reflected in both the NAV and the share price. So you can see there. Now, the reason we're talking about it today is because it is the big holder of Hargreaves Lansdown. And this morning, the bid for that company has been recommended at £11.40. If you're a Hargreaves Lansdown customer, which many of you might be, I don't think you'll see an awful lot of change to start off with. It's been bought by private equity owners, but I think they'll just try and run it as is, and they may try and grow it. They may buy other things, as one of the things that private equity often does. And they may look for ways of improving the service and selling you more things. So it's another way of improving the profitability of it. Anyway, so £11.40, the board said yes, we will be happy to do that deal. It's a big chunk of Finsbury Growth and Income's portfolio, but there isn't much of an uplift that's going to apply to the NAV now because it was already valued at £11.32 on the end of June 2024. They also announced results this morning, and it's debatable how that would have gone down the market without the bid. I think it wouldn't have been taken very well, to be honest. And that's a pattern that we need to worry about a bit. So this is supposed to be a growth stock. Client flow inflows are still happening, but they have slowed down, and the underlying profitability may have been up slightly, but earnings were down, earnings per share down. So I can easily imagine that share price would have come off were it not for the bid. Now, this is a bit fuzzy, and I apologize for that. But what I've pulled here out, this is from the interim report. This is the Finsbury Growth and Income portfolio. Just showing you the difference between September and the end of March. What I've tried to put here in the column, they more or less match up, is what the share price of returns have been since the 31st of March, so up until last night's close. And there have been some fairly big moves. This is the top 10 investments. Obviously, a very concentrated portfolio. It's one of the things that Nick Train does. Hargreaves was number 11 on that list at the end of March. And there's only propelled to the top 10 recently because of the bid speculation. So it's up 46% since the end of March there. But there's been some other things going against it, which we talk about in a second. So Finsbury Growth and Income's performance, which I've shown you was at the bottom end of the table, is way more than being caught out by Burberry, which is one of the things that happened most recently and attracts all the headlines. So just looking, I mean, I know there have been purchases and sales within the portfolio since, so this is slightly misleading. But had the portfolio not changed since the 31st of March, you can see that Burberry wasn't even the worst thing to hit the fund. Sage took more money off than that. Diageo is also a fairly big hit too, and so is Fever-Tree. And the worrying thing to me, and this is again the pattern of the way that Nick translates, he tries from quality things, he doesn't mind paying up for them, which is why the yield is low. But these things, even after the falls, are still quite expensive. And to me, that's a worry. There are things that have offset that. So Unilever's done all right, and obviously the Hargreaves bid. But again, so you can see the Hargreaves bid that isn't the biggest positive thing either. So these Burberry and Hargreaves are attached to all the headlines, but actually it's Sage and Unilever that have had more of an impact. So stepping back a bit, the peak of the share price of the growth and income was in September 2019. And we're still about 12% off that, despite the fact the market's rallied a bit since then. They've been buying stock back, and they've been accelerating the process of doing that. So since the end of September 2019, when the share price started to crack, they bought back £227 million worth. But more than half of that has been bought back in the last 6 months. So the fund is really shrinking quite rapidly now. 10-year numbers are still okay. And it'd be nice to think that it will go back to where it was and be the best performing fund again. I think that's dubious. I don't think the market is likely to favour that in the short term. But it is worth, if you are interested in looking at it, given that it's on a wider discount than normal now, and you're wondering whether it might turn around, go back and watch the interview that we did with Nick on the 28th of June 2024. Okay, so that's enough from me. We will now talk to Matt. So good morning, Matt.
Good morning, James.
So thank you very much for doing this. As usual, I'm going to hand over the show to you for a bit and just let you talk about rights and issues, what it's trying to achieve, please, and how you go about it.
Absolutely. Yeah, thanks. Well, thanks for having me, James. And I'm glad to hear you've had a quiet week. It's been an interesting one in the markets. So we started the week with the drama in Japan, and obviously a lot of that's to do with nervousness around US growth, which, despite being a UK small cap manager, affects a surprisingly large number of our holdings. It's actually been quite a big week for company announcements as well. Well, it's always difficult to generalize from lots of different things. It's interesting that those that do touch the US economy, generally speaking, have remained pretty positive. So in terms of sort of actual action on the ground, it doesn't feel like anything's cracked yet, but we shall see. So yeah, here to talk about rights and issues this morning. Yeah, thank you for bringing that first slide up. And as you'll see here, I guess the dry facts about rights and issues are that it's a sort of £140 million NAV, £130 million market cap trust, which operates as a long-only UK equity fund, and with an emphasis on smaller companies. The story behind it, though, I think is possibly a little bit more interesting. And I know some of your listeners will have heard this before, but I think it's interesting because for 39 years, up until October 2022, the company was run pretty much as a one-man band by a gentleman by the name of Simon Knott. And over that time, the company returned in the region of 12% per annum compound, which compares to about 5% for the FTSE All-Share, which is its benchmark. And Simon, I don't think you'd mind me saying, is a fascinating character. He's a chess grandmaster. He's a polymath. He's incredibly well informed on a whole range of subjects. But after 39 years, he decided to take a step back from day-to-day management of the company. So the board set out to find a new manager, which is where we at Jupiter come into the story. And here's worth just mentioning, Simon still sits on our board. He's still one of our biggest shareholders. He, as you'd imagine, knows a lot of the companies very well, but also is very good at providing sort of board level challenge to us as an investment team. But in any case, as I say, the board set out in 2022 to find a new manager and appointed Jupiter's mid and small cap team, of which I'm part. And I think what they liked about our proposal was firstly that we could take rights and issues and put it on Jupiter's sort of modern full scale investment platform. A very well resourced team, backed up with all the functions that you'd expect from a full-scale asset manager, so risk control, dealing, marketing, and of course ESG. And I think the board presumably liked our approach to investing in smaller companies, which we'll come on to in a moment. But I think actually what they were really attracted to was our intention to preserve and to respect the philosophical underpinnings of Simon's approach that had worked so well over all those years. And those are really around sort of long-term approach, high conviction, low turnover approach to portfolio construction. And so the idea today is that we take some of that long-term philosophy that's been so good for the portfolio and combine it with what we have at Jupiter and make it a more interesting proposition. So if you wouldn't mind just flipping over onto the next slide, and we'll just do a quick introduction to the team. Those who've been following Rights and Issues will see a change here in that when we took the portfolio on in 22, the team was me and Dan Nichols. Dan will be a familiar name to many small cap investors. He's been one of the sort of leading lights of his generation in the sector. But Dan retired at the end of June this year. So we've had a bit of a reshuffle, and the Rights and Issues, the immediate Rights and Issues team is now me and Tim Service. Tim has also taken on leadership of the overall mid and small cap team, as well as our mid cap fund. He's a very long-standing member of the team, a very experienced mid and small cap investor, and so is this I guess was part of the proposition from Jupiter was the succession, and Tim has slotted straight into the team. And then if you don't mind spinning on just one more slide. So this is the broader small and mid cap team. So the core of it are the four of us, 3 investment managers and an analyst. And of course, what we don't show here is all the sort of broader UK equity team that we have at Jupiter. Jupiter are probably quite distinctive in that we're very committed to UK equities, very determined that the UK equities will be a core part of what we do. We have recently been joined by the team from GAM, Adrian Gosden and Chris Morrison. We will soon be joined by Alex Savides coming from Hambros as well. Some of his team are already in the building, as well as some of the existing folks in UK equities. So it's a very broad and deep group of UK investors that ultimately sit behind this, as well as I say, as all those sort of support function, and we show on here the governance and the sustainability teams, which are obviously key to what we do. So that's the team. So moving on. Just want to talk briefly about UK small caps in general. And I'm conscious that a lot of these arguments will be well rehearsed and people will have heard a lot about them. I think there's an interesting point from a Rights and Issues perspective. As I mentioned earlier, the formal benchmark for the trust is the FTSE All Share. And the board are very determined to keep that rather than use a small cap benchmark, because they see the emphasis on small cap being as an important way to outperform the wider market. So we very much see small cap as a choice for the reasons I'll come on to, rather than just a sort of set mandate that we then don't think about. And I think there are a couple of important proof points here that we always go back to. And first, and I suppose ultimately most importantly, is that smaller companies have tended to outperform larger companies over the longer term. And for those who don't know, the authorities on this are a couple of professors from the London Business School, Paul Marsh and Scott Evans, and they produce what is now the Deutsche Numis smaller companies series of indices. They were the Numis indexes, and before that the Horgevet. But the production of those indexes has always stayed the same. And the reason they're interesting is that they've got a back history that goes all the way to 1955. And if you take that period, 1955 up to the end of last year, the core smaller company, Numis Smaller Companies Index, returned about 14% on average a year, and that's compared to about 11.5% for the FTSE All Share. Interestingly, they also these days produce a microcap version of the benchmark and a mid-cap version. The microcap index has returned about 16% PA, and the mid-cap sort of in between small and large at about 13%. So what they've shown is that not only do smaller companies tend to outperform, but it does seem that you get this effect that the smaller the better. Obviously, it's important to say that it doesn't necessarily hold in any given year, and it can break down over relatively long periods, even sort of 10 years. But the data still says that over the long term, small caps tend to outperform. And the reasons you could spend hours on all the minutiae of this, but there are a couple of things which we sort of illustrate on this slide that we think are important here, particularly around the sort of the level of research coverage and the development of price anomalies, technical factors that move prices away. And there are some good price points, some good proof points here when you look at them. So one of the things is that if you look at the dispersion of returns in the small cap world versus big cap, it's much broader. And the other interesting thing is that if you look at the performance of the average small cap fund, so if you just go and look at sort of IA sector small cap funds, they do on average tend to beat their benchmark, which obviously big cap funds famously do not. So all of this, you put all of this together, and what we think this means is that this is just a really good place to be a stock picker. So not only do you get better returns, but there's a better opportunity to generate alpha. So as I say, except that all of that is rather well set. And if you go on to the next slide, I shall make another point, which I know has been made rather a lot in the past, but feels quite pertinent at the moment. And this chart just shows, this is just the forward PE for various benchmarks. And it just illustrates on the right hand side. You can see this is a long data set now, 30 odd years. On the right hand side, the gap between the US, which is that sort of brownish line that's split itself off, and the UK markets has become very wide. What it's easy to forget is that those lines do come together periodically, and actually the last time the valuation of sort of UK mid caps and the US was pretty much the same was actually only 2015. And while we don't want to get into the politics of Brexit, but clearly there has been a perception that the UK has been a difficult place to invest, perhaps less well governed over that period. So there's some optimism today, I think, around perhaps just a bit of a normalization of that, and therefore an opportunity to close that gap up. I would just make one final point on this. One of the pushbacks you often hear when you look at data like this is that this is just purely a function of the sectoral mix between the US and other markets. But there's some good research that the folks at what is now Panmure Liberum put together, which is a sector adjusted PE, which shows that's part of the effect, but actually most of the effect is still there, even if you adjust for the sectoral differences. So we think small cap is a great place to be long term. We think it's a good place to generate alpha, and we think it's an interesting UK is an interesting place to be at the moment. So I'll move on to how we try to address that. So this is how we show our investment approach. And it's worth saying that as a team, as a mid and small cap team, we run a number of mandates across our space, and they include traditional long only small and mid cap funds, but also some more flexible funds that can go short, and one of which is fully market neutral. And the idea of the way we run the team is that we have a common stock picking process, which is here, and then we apply that in different ways to the different mandates that we run. And I'll come back to what that means for rights and issues in a moment. In terms of the process itself, the first thing that you might notice is that we explicitly build in a top-down element to the process. We're very clear this is not a macro-led approach. We don't spend our time trying to anticipate the next move in interest rates or predict big macro events. We describe ourselves more as macro aware, and what we mean by that is that we recognize that the market will go through phases in which certain sectors or themes or factors will tend to dominate. And when we recognize that we're in one of those phases, we try to align portfolios with that sector or theme or factor. So rather than sort of trying to fight the market, actually, for what it's worth, the last sort of 2 or 3 years, we felt that actually that there hasn't been really much clear market leadership, and so actually where we are today, the portfolios are sort of quite neutrally positioned, because we don't see that there's something happening, and we're not trying to anticipate it. So that macro awareness aside, the process is predominantly very much a bottom-up stock picking approach, and we focus on 3 key criteria, which are sort of the slightly below the middle of the slide there, when we're looking for investments. The first is that we're looking for companies with the characteristics that deliver sustained above average earnings growth, and those tend to form the core of our portfolios, because experience just suggests that these are the companies that ultimately tend to create the most value over time. So those are your businesses that have high returns and the ability to reinvest and compound those returns. Secondly, we look for companies that we think have a prospect of delivering positive earnings surprises, and by which we mean where our research suggests that there's a good chance of profit outcomes that are better than market consensus. As you'd imagine, that tends to be somewhat more opportunistic in nature. And then finally, we look for stocks where we think there's the potential to earn a re-rating, so a higher multiple. And these are often businesses that are going through some kind of change, perhaps new management, change of strategy, something in the market that is changing or inflecting. And as you might imagine, the very best ideas tend to be where there's an element of all 3 of these. So perhaps a business which is going through some sort of change, which we think will allow them to grow faster, deliver those earnings surprises, and ultimately, as it becomes recognised by the market, re-rating. What all this looks like in practice is just very much a lot of diligent research and work. So we spend a lot of time meeting management teams, visiting companies, speaking to sort of various stakeholders, staff, suppliers, customers, competitors, and so on. We often build our own financial models, and we do work closely with the sell side, so that we understand businesses as deeply as possible. It's very much a team-based approach. So the 4 of us in the core team, we all have sectors that we cover individually, and then effectively we're all working for each other on the mandates that we run. So I guess on that point, with rights and issues specifically, what we're trying to do with portfolio construction is sort of respect and bring in the benefits of that philosophy that worked so well for 39 years under Simon Knott. So it's concentrated. We have about sort of 20 stocks. It's a long-term, low turnover approach. There has been a period since we took it on where the turnover has been a little higher. But in principle, what we're looking for is those sort of long-term, high conviction ideas that we can put into the fund and hold for a very long period. Having said that, what we have done since taking on, when we took the portfolio over, it was about 20 stocks, but it was very concentrated in the top few holdings. So the top 10 positions accounted for 84% of the NAV when we took it on. Today, that's about 62%. So it's still a very concentrated portfolio, but we think we've got a better spread of risk. And the idea is to just mitigate some of that single stock risk. So if you don't mind flipping over onto the final slide, I'll just give you a very quick run through of 3 of the most recent additions to the portfolio, just to try and bring that process to life a little bit. And I'll start with Oxford Instruments. So for those who don't know it, Oxford is, we see this very much as a global leader in some very specific high-tech niches. So they're experts in things like advanced microscopy, imaging, and cryogenics. And they have a wonderful history, starting out in the proverbial garden shed in Oxford, in academia and then research. But what the company's been trying to do over recent years is take that expertise and apply it more broadly into commercial end markets, which are naturally much bigger and offer greater growth. And essentially, that strategy has started to bear fruit. So what we think we've got here is a business that's gone through a change, is now growing fast, and has that opportunity to surprise positively. and it's still on what we think is a pretty sensible valuation as an entry point. So it's a sort of natural long-term holding for a fund like rights and issues. Secondly, very different, we have Jet2, which is now it's actually the UK's largest short-haul holiday company by number of IATA licenses, and it's got a unique for its niche vertically integrated model, in that it's a holiday company by nature, but it owns its own airline. And what they've built over the years is a much more customer-centric proposition with really good products and really good service. If anyone's flown with them, it's just very noticeable that you don't have to be at the airport at 4 o'clock in the morning. They have more staff on the check-in desk, so you don't have to stand in a queue, and they treat you like a human being on the plane. And so they've differentiated themselves and have grown market share really strongly over the years. It is, however, it's a holiday company. It will have some volatility and some cyclicality. And for that reason, the market is wary of it and rates it very lowly. And we think that's, again, is a great opportunity, because with a fund structure that can wear some volatility, the underlying growth is strong, and so that fits really well. And then finally, GB Group. GB is it's a sort of one of the world's largest independent ID verification and fraud detection businesses. So it's software and services, and has generally been seen as a great UK success story. That their USP is they're independent, so they're able to offer global coverage where even the really big credit reference agencies tend to be tied to certain jurisdictions, which means that they can't meet all of their clients' needs. And GB steps in there. GB rode the sort of the COVID e-commerce wave very strongly and became very, very expensive as a share. And then as that effect unwound, got somewhat abandoned by the UK market. And as ever, the truth is sort of somewhere in between. We think there's really good, attractive long-term growth here. And that sort of post-COVID pullback has offered a really good opportunity to come in for rights and issues. So I'll probably leave it there and move on to questions. But I guess just to try and sort of summarise what we're doing with rights and issues. I mean, we think that this is a pretty much unique history as an investment company, a great track record, and we just think it's exciting to be able to combine that with what we have at Jupiter, the investment platform, and that stock picking process I've just talked about. And I just think today that's quite an interesting proposition. If like me, you think that UK small caps look like an interesting place to be at the moment.
That's great, Matt. Thank you. Have we got a slide with the portfolio on it somewhere?
Yeah, if you keep going.
There we go. Cool. We'll just have that up in the background while we talk for a bit. Now, I suppose just thinking about the macro bit for a bit. What's actually happened this week within the portfolio? You mentioned that there've been some kind of knock-on effects, but are these companies much affected by the kind of gyrations in big stocks in the US, or just plow on as normal?
Yeah, I mean, well, I think there's probably a difference between what happens to share prices and what happens to businesses. I think to a certain extent, it's just we're getting into mid-August, liquidity is low, and market makers are nervous, and so you do tend to see just a sort of pullback, almost apropos of nothing. But I mean, look, some of these businesses do have Hill and Smith would be a really good example. They've been trading very strongly on the back of US infrastructure investment. Were the US to have a really sort of deep, severe recession, then some of that would likely be affected. And so it's not completely irrational for the market to take a slightly more nervous view around their prospects. But then you talk to the business and they say, well, look, trading's been great, order books are fine. No one's got, they've no more crystal ball than we have. But there's nothing actually on the ground that's telling you that you've got a problem.
Okay, well, I think that's encouraging. The other thing we've had recently is the sort of first interest rate cut, which we've been waiting for ages, but finally arrived. Did that have an impact? And do you think, well, I suppose, do you think there'll be more of them? And do you think that, how important do you think they are for UK small caps?
Yeah, I mean, it's interesting. I think with this interest rate cut at least, but probably in general with monetary policy moves these days, they're so well signalled that actually when they finally arrive, not a lot happens in the market. And there was debate around, would it be August, would it be September? Was there a tail risk that inflation might flare up again and it didn't arrive? So those sort of things would be debated. I mean, these are not, as I said earlier on, these are not things that we try to spend too much time trying to second guess. But I think the central case had become pretty clearly in markets that the cutting cycle would start. And ultimately that's important for a lot of our businesses because the whole point of tighter monetary policy is to slow the economy down, and so as it loosens, all sorts of things start to move again. Do I think we're getting more rate cuts? Yes, at some point. Again, I'm trying. Well, we as a team, we try quite hard not to spend too much time worrying about exactly the time and the path. If as I say, if you started to get another inflation flare up and all that got pushed out indefinitely, a number of these businesses would ultimately see a knock-on effect. There's no doubt about that. At the moment, my best guess, my central case is that market pricing is probably about right for it. I have no reason to think that's not the case.
One just popped up as we've been talking there. So with the new government, does that make much of a difference to any of these?
So, I mean, again, the election itself, the result was so clear and so obvious that, again, I don't think made any difference to share prices on the day. I mean, it's interesting talking to businesses because I think Labour have they spent a lot of time trying to talk to companies, and I mean they came to talk to us at Jupiter and lay out a case that they can be good for business. At the same time, of course, no secret that a big part of Labour's election strategy was just don't be the Tories but don't say anything. So I think there's a little bit of wariness around exactly what we get in practice. But for most of these companies, there isn't a huge amount of sort of policy differential, and actually what they want more than anything else is just stability and sensible good governance, and they I think hopefully that's what we're being offered here. I think there are pockets across the market, and perhaps not really so much on this portfolio, where things like Labour policy, as in not as in the party, but as in policy around sort of pay and working conditions, can have an impact, and that's particularly acute, I think, for sort of leisure, and retail, where there's lots of people being paid at or around sort of minimum wage and living wage. And I think there's a little bit of nervousness there that they're going to have to find ways to offset a bit more labour cost inflation. The tail risk in that people flag is that triggers another wave of more general inflation, and that obviously can affect businesses across sectors. One likes to think that the government and the Treasury are acutely aware of how that of the risk there. So I'd see that more as a tail risk than anything central. But yeah, generally speaking, when you talk to companies, apart from relief at the idea that we just might have some stability, you don't pick up widespread concerns. And actually, there are definitely some opportunities. I mean, if Labour can't build more houses, they're going to have egg all over their face. So a company like Marshalls, which you'll see on here, which is a building materials supplier, we'll hope to benefit from that as it starts to come through.
What's kind of split between domestic economy and selling stuff overseas within this portfolio? And does the sort of move in sterling make a difference?
Yeah, so we haven't actually done the calculation on the current portfolio, but this is there's clearly a pretty significant mixture here. Everything from sort of almost entirely global companies where the UK is going to just be a small part of what they do. The big industrials in here like IMI or Spirax, through to entirely domestic businesses. So Telecom Plus, which is people might know it better as Utility Warehouse, independent energy and telco reseller, which is entirely domestic. So clearly the currency impact can be different in different places, and obviously for those dollar earners, the strength in sterling has been a little bit challenging, but that comes and goes, and generally, my feeling is that generally that doesn't affect multiples and therefore doesn't have a huge impact on share price, other than when you get a dramatic move, you can see it sort of in the short term in prices. But we try not to be overly distracted by moves in currency. There are some businesses in here which have I mean, Oxford Instruments would be an example where they're a genuine exporter, where they're making things in the UK and have a cost base in the UK and selling elsewhere, where they need to be a little bit more sort of in principle a little bit more careful about currency exposure. But again, because they're a very niche specialist in what they do, there will be less sort of dollar price elasticity, because for a lot of their products, they're the only place that you can come to get them. So FX exposure is something that we talk to all of our businesses about, all the relevant businesses about, but we try not to be sort of overly swayed by sort of short-term moves in FX, because again, it's just one of those things that we're never going to predict. Interestingly, Alpha on there, or Alpha Group International, to give them their full name, big part of their business is effectively an FX brokerage, although the model is a long way from a brokerage model, but they help companies with their FX risk management. And of course, actually, currency volatility is quite good for them, because it reminds companies of why they're needed, and is actually sort of drive some business development. So it can often be swings and roundabouts at a portfolio level.
Looking at this portfolio now, what are the big changes that have happened since you took it on from Simon? Let's do that one first.
Yeah, so structurally, as I mentioned earlier, if you looked at this on sort of day one, the largest position would have been around sort of 13%, and then down at the other end of the portfolio, there were sort of 8 to 10 stocks below 1% in very sort of tiny size. And so structurally, what we've done is effectively flatten it. So the largest positions are smaller, the smallest positions are bigger. We think that all of these holdings will contribute, although it is worth saying that the two right at the bottom of the portfolio, Gresham and Spirent, have both been have both had takeover bids, and actually, so this was obviously cut at the end of June, but and both now left the portfolio. So if you think about it conceptually as a 20 stock portfolio, so therefore averaging a 5% holding, and somewhere around that sort of 2 to 8-ish type range. So that flattening is the main thing. The other thing is that Simon and our board have probably a heritage in industrials, and had a very heavy focus on industrials in the portfolio historically, partly in terms of number of names, but actually in terms of the things that they allowed to become very, very big holdings. And one of the things we tried to do is bring in a bit more sort of sector balance. So if you skim down the holdings, the things we brought in: Gamma Communications, Telecom Plus, Alpha, as I just mentioned, Oxford Instruments, OSB, which is a specialist lender, GB Group in technology, Jet2 in travel, These are all sort of outside the areas that perhaps would have been the natural comfort zone for the board before our arrival, and that's again is very much deliberate, not because we necessarily dislike industrials, but just because there will be times when they're out of favour and underperform, and again what we're trying to get away from is an unintended skew to a particular in this case sector, but or theme or factor. So I think in a number of ways you've got a more balanced portfolio today than it would have been.
And the other questions on here is, does anything change with Dan retiring?
No, really not. So because of the way that we work the team, this very team-based approach, there's nothing that we would do or have done or would do to rights and issues that wouldn't have been a broader team-based decision. So although day to day, Dan and I, now Tim and I, monitor the cash levels, think about position sizes, sort of work on the portfolio construction, actually, when we get together as a team, we'll review the portfolio, review all the holdings. So some of these holdings will be under my coverage, as it were, but some will be the other members of the team. So we all feel like we own everything. So for Tim to step in wasn't anything new for him. He knew the portfolio, knew what we were doing with it, and I think that's very much part of the proposition to the board, was that we would have this succession planning and ensure that when things change, and inevitably things do change from time to time, that everything would be very seamless. So there haven't been any changes, and while inevitably things will evolve over time, none of that will be different because it's me and Tim rather than me and Dan.
You mentioned Gresham Sparrow getting taken over. That's been a big sort of factor within the market recently. Do you think that's ongoing, that you're going to see more and more bids, or we've reached the end of that now?
I mean, we obviously seen HL bid for today. As you say, it's been a strong theme. Yeah, sort of bit of a bout of sterling strength perhaps takes some of the edge off that. But I go back to that valuation slide that I showed earlier, and the UK still looks pretty attractive. And if you're an industry buyer in the US looking at that big rating differential and feeling that actually maybe the UK now is somewhere that you could operate and feel comfortable operating, these are great opportunities. Perhaps a bit of the frustration for us, and I'm sure other UK managers would say the same thing, is you get the sugar rush of a bid on the day, but actually having a lot of these really good businesses taken out and removed from the UK market isn't a good thing long term. So yeah, I always have slightly mixed feelings. Gresham would be an interesting example. They are, they're a little business, don't get me wrong, but they have a very strong niche in the area of high-speed reconciliation software. And that's something that's going to be a growth market. And so the fact that that's now gone and with the UK market doesn't benefit from it is a bit sad, albeit, as I say, it feels more positive on the day when you get the bid and you get a nice performance tailwind.
You've probably, I think you're ranked sort of third or fourth in the sector in terms of performance over the past year. What's been contributing to that?
Well, one of the things that's pleasing is that it has actually been reasonably broad-based. So I mean, there are some superstars, of course. So Reynolds, which is a position that was on the fund when we inherited it, has been the absolute standout. And interestingly, it was an inherited position, but interestingly does fit the model of our investment process. So Reynolds, for those who don't know it, they're the world's second biggest maker of industrial chain. And just to be clear, when I say chain, this is not welded link chain like anchor chains. This is generally leaf and pin chain that can drive anything from sort of little tiny chains that drive robots that are automating a manufacturing line, through to huge chains where every link is the size of your head, that are on ships laying pipes across the ocean. And has always had this very strong brand, very strong technical leadership, but had been, probably fair to say, mismanaged. A lot of M&A that came with pension funds, and by sort of 10 years ago had become, frankly, a pension fund with a little business on the side, desperately trying to generate the cash to fund it. They had a new management team come in at that point, rationalized a lot of the business, focused on what they were really good at, just did lots and lots of the sort of the right things in terms of lean manufacturing, got the margin up, and started sorting the pension out, and had got an awfully long way through that process when COVID hit, which kind of obscured the progress they'd made. But as we've come out of COVID, the business has just flown. So it's performing really well. They have sorted the pension fund. I mean, it's still there, but it's no longer an existential threat. And so what you've seen is an inflection in growth, which almost by definition has surprised the market. And now it's earning a re-rating. I mean, for what it's worth, it's still cheap by any standards. But that's been been wonderful to see, and has been a superstar. But some of the things that we've added to the portfolio since we took it over have also really contributed. And again, Alpha would be a good example. I mean, this is a business that we've owned as a team and in our previous teams since its IPO. It's founder-led, very entrepreneurial, and has this wonderful mindset of taking sort of poor markets and approaching them in a different way, and FX is the exemplar of that. So the guy who founded it, Morgan Tilbrook, had worked in FX broking, and it's a horrible business, FX broking. It's just lots of people sitting in a room dialing finance directors and hassling them to trade today, come on, trade today, because there's going to be a move in the rate. So it's very transactional. All the economics tend to flow to the staff. It's a grim business. And what he said was, look, there's got to be a better way of doing this. And they set out to approach businesses and say, look, don't trade today, but we'll help you put together an FX management plan, and then we'll make money off the back of executing that for you. And it's one of those, it sounds very logical, may or may not have worked, but by the time they IPO'd, they showed that it definitely did work. And so they've really changed that market. And the acid test of whether you've changed a market is whether your competitors start describing their business model in the same way, which they now do in that space. And then they're going off to attack some other markets. And Alpha has performed really well since we put it on the portfolio. And again, is one that we think has real sort of longevity. So as I say, what's pleasing is that it's been pretty broad based. There have been relatively few disasters since we took it on, and that, in a concentrated portfolio, that's kind of what you're aiming for. Things will perform better and worse, but it's trying to sort of stay away from those real sort of car crash situations.
What does the trust share register look like?
So again, it's pretty concentrated. Simon and his family are still very significant holders, and there are some other sort of family type holders at the top of the register. That, frankly, is a challenge for us. Liquidity is not as good as we would want it to be. The board does have a standing discount control mechanism in the form of a buyback. So we buy typically about £1 million worth of shares back every month. But part of what we're trying to do as Jupiter is bring the trust to more people's attention, highlight the opportunity as it stands today of a reasonably significant discount, and try to diversify the register. I mean, the interesting thing is that I don't think that any of those big holders have been sellers. And so you're always in that sort of slightly circular position of, frustrating low liquidity, but actually even, you can't, it's actually quite hard to buy the shares. So, it's something that we're very conscious of and would like to try and move on.
Yeah. One last question, because people always ask it. Have you got shares in the trust yourself?
Yes, I do. So I bought some when we initially took it on, and I bought some more since. And I will say that I own some personally, but I have also put these into my kids' junior ISAs because it's interesting. People often sort of talk about small cap as being higher risk, a little bit sort of Wild West and not for widows and orphans. And well, my children are obviously not orphans. I do think that they have the really long investment horizon, and that for me is the key to this. Is that if you can be patient, the opportunity here is pretty significant. Albeit trying to call when the timing of that will happen is a mug's game.
Great, thank you very much indeed, Matt. That's really helpful. We shall follow with interest. I think we've got notes we've been publishing, so we'll keep going on those. And we'll get you back in a year or so and see how it's been going. But thank you for today.
Great stuff. Thanks, James.
So next week we're back talking to another UK manager. So it's Ian Lance from Temple Bar Investment Trusts, which is again another one of the sort of better performing UK equity funds at the moment. And then the week after, it's Craig Baker talking about the merger between Alliance and Witan. So that's going to be quite interesting, I think. So with a full lineup, as we've often said, next quarterly panel show on the 20th of September. Hope to see you then. But in the meantime, have a good week, and we'll see you next week on the 16th of August. Thanks. Bye-bye.